I'd like to thank The Economist for the kind invitation, and it's a great pleasure to participate in this panel with the ECB Vice President, great friend, Boris Vucic, and the CEO of the National Bank of Greece, and also great friend, Pavlos Mylonas. Few things about the world economy. I think the agreement on the 17th of June between the US and Iran had led to an unexpected reduction in energy prices, close to levels prevailing before the war. And these developments, if sustained, could have led to higher growth and lower inflation compared to previous forecasts. And it is indicative that annual inflation in the euro area fell to an unexpected 2.8% in June from 3.2% in May. However, hostilities started again, so we are back to square one, and that shows how precarious and volatile is the situation in the Middle East, and as a consequence, energy prices. It also shows the uncertainty surrounding inflation forecast and therefore the challenges that monetary policy has to face. I'd like to zoom on the recent developments in the Greek banking sector. The Greek banking sector, as well as the Greek economy and the fiscal situation, has been a success. Banks now are well capitalized. They are financing the economy. All the metrics are above the minimum requirements. So along with the fiscal situation and the macroeconomic developments, they form this success story of the Greek economy. I'll come to the RRF, because the question is what's going to happen to the country when the RRF ends. We don't see a cliff. Greece now enjoys very high foreign direct investment from abroad, and also European programs continue. So we don't see in the Bank of Greece any cliff effect after the end of the RRF, which actually has played a very important role in the financing of the Greek economy. Net credit expansion now, as Pavlos will say, also runs much higher than nominal GDP growth. So there's ample financing for the Greek economy. Turning to Europe now, the great challenge is to complete the banking union, the savings and investment union. As you know, in Europe, we have much higher savings than in other parts of the world, especially the United States. We have a current account surplus of about 2.5% of GDP. That means that we save more than we invest. But up to now, most of these savings, these excess savings, are flowing abroad. So our main task now is how to use these excess savings to finance investments in the European Union, following the directions of the Draghi and the Letta report. So for us now, it is extremely important to complete the capital markets union and the banking union, to cut fragmentation, so that we obtain higher scale in Europe and increase the efficiency. So we have enough savings in Europe, but the question is how to turn these savings into higher investment, and especially higher investment in the digital economy, in the green economy, and in defense. So I think that's the main, I would say, task for Europe now.
Okay, I'm keen to explore that in a little bit more depth, which we will do in a second. Before I move on, I just wanted to come back to something you mentioned, the resumption of hostilities in the Gulf, which raises a question, I think, that's in everybody's minds. Are we in a moment of transition from one kind of peace and stability to a new kind of peace and stability, or is this instability the new shape of the world? As a central banker, you would like to be able to see stability on the horizon. Do you see it?
I think there is a very close correlation of energy prices with inflation, and Europe is still a large energy importer, so it is crucial to have stable supplies from the Middle East. The resumption of hostilities means that these supplies have been cut again to some extent. So that has produced a lot of volatility. The Brent price is more than $80 today, this morning. It was lower than 70 a week ago. So that shows the volatility and how precarious the situation is. Nobody knows what's going to happen tomorrow, because there's a lot of uncertainty surrounding these developments there. And this is not risk, this is naivety and uncertainty, actually. It's unknown unknowns. And so we have to form our monetary policy having this in mind.